firms, how to dissolve the partnership firm, and if all the assets and liabilities realized on the same day, how to dissolve the firm and how to do the accounting. And if the assets are realized piecemeal, that is realized in installments, then how to adjust for that. So in the case of insolvency of a partner, how to deal with the dissolution, and if all the partners become insolvent, how to deal with that situation. All those things we have learned in the all these things we have learned in the unit 1. Now we are moving into the unit 2. Here in this unit 2, our objectives are to learn the accounting treatment in the case of amalgamation of partnership firms. What is amalgamation of partnership firms? When there are 2 or 3 partnership firms come together and they form a new partnership firm, that is called amalgamation. For example, A and Co, B and Co, C and Co are 3 different partnerships. If they decide they want to amalgamate and they will start a new partnership firm, ABC and Co, that will be called a amalgamation. So what are the steps involved? In this case, the erstwhile or the previous partnership firms A and Co, B and Co and C and Co will be closed down and ABC and Co will be opened. This is called a amalgamation. Another thing is conversion and sale of partnership firms. Sometimes partnership firms are sold as a business, as a running business, they will be sold. Rather than selling as a land, building, machinery, stock individually, they will sell the entire business as a going concern to another business business entity. That business entity can be a partnership firm, it can be a sole proprietorship, it can be a company. So sale of partnership can happen to any kind of business entity. So we will learn in this class how to deal with the sale of partnership firms. And another thing is conversion of partnership firms. Many times what happens, the business of partnership firm will become so large that they will think that it would be better in a corporate form. It is better to convert the partnership into a private limited company. So in this case, what they will do, they will do the same business, but the entity they will convert from the form of partnership firms to private limited company, or they may even sell it to a public limited company. But many a times they are converted into a private limited company, so that once the business becomes so large, then there will be a limited liability. The partner's private assets will be safeguarded. So in unit we are going to study about 1, amalgamation of partnership firms, 2, conversion of partnership firms, and mostly in the form of a company, that to private limited company, and sale of partnership firms. So first we will start with the amalgamation of partnership firms. So in the amalgamation of partnership firms, there are few steps involved. So what are the steps involved in amalgamation of partnership firms? The steps are: 1, for the old or existing firms. As I told you in the example, A and Co, B and Co, C and Co, they become A, B, C and Co. So A and Co, B and Co and C and Co will be called as old firms or existing firms. So what type of entries should be passed in the case of existing firms? First, we have to prepare a revaluation account. In the case of dissolution, what we have done, we have prepared a dissolution realization account. Here, in the case of amalgamation, we have to prepare a revaluation account. What is a revaluation? We have to, actually in the books, what we'll be having the historical cost. All the assets and liabilities will be shown at the historical cost. Since the firm is amalgamated now, what we need to do is we have to bring in the market price. For example, if the partnership firm purchased one building, say let's for 20 lakhs, let's say some 10 years ago, the current value will not be the same 20 lakhs. It would have increased. Maybe it would have become 1 crore. So on a day-to-day basis, we don't do the revaluation. But whenever there's a special occasion like admission of a partner, retirement of partner, or in the case of amalgamation of partnership firm also, we should prepare a revaluation account. Meaning we have to state the value of assets and liabilities at the market prices rather than the cost prices, historical cost prices. So we have to prepare a revaluation account, and whatever revaluation profit or loss, it should be transferred to the partners capital accounts in their profit sharing ratio. That is the first step. Till people are joining. So the second step is that we have to make adjustments for goodwill. What is goodwill? Goodwill is generally the ability of the business to generate excess profits. A new business and an existing business there will be a huge difference. The existing business will have either locational advantage, or they will be having a customer base, or they will be having a good brand recognition. Their quality and their service, all these will be known in the market. So they will command a premium. So that will be called a goodwill. So whenever there is a amalgamation, we have to account for goodwill. Whether we are showing it in the books or not, it's a different thing, but we have to definitely make adjustments for goodwill. And another step number 3 is we need to transfer all the assets and liabilities taken over by the new firm to new firm's account. So all our assets will be having a debit balance. What we need to do now, we have to credit all the assets and we have to debit the new firm. And we have the liabilities will be having an existing credit balance. We have to debit all the liabilities and transfer the balance to the new firm. So in this way, all the assets and liabilities taken over by the new firm will become zero in the existing firm's books. Sometimes the new firms will not take over all the assets and liabilities of existing firms. Then what we need to do? In the case of assets and liabilities not taken over by the new firm, they are to be transferred to the partner's capital account in the ratio of their capital. It is not in the ratio of their profit sharing. It should be in the ratio of their capital. Then final step is partner's capital account also should be transferred to the new firm's account. So now we have dealt with all the assets, liabilities. The remaining item will be only partner's capital. That will be the last step. It will also be transferred to the new firm's account. By this way, all the assets, liabilities and partner's capital account, everything will be closed. So our existing firm's books will be closed. It will be zero. Then the next step, it is in the case of a new firm. ABC & Co is a new firm, that is amalgamated firm. What they need to do, they have to debit all the assets and credit all the liabilities at the values taken over. And second step, they need to credit the partner's capital accounts at the values transferred from old firms. So these are the things the new firm has to do. So who has a lot of work? The old firm has a lot of work. New firm has very little work. But unless you do the revaluation account, unless you transfer those balances to the partner's capital account, you will not have the step number 2. What is the step number 2 in the case of new firm? Credit the partner's capital accounts at the values transferred from old firms. So, in order to arrive at the partner's capital accounts at the old firm, we have to do all these steps. If you do all these steps only, you will get this. So, directly or indirectly, you have to do all these steps. Whether the question is asked about new firm's point of view, definitely you have to do the workings for old firm also. But this will be part of the working notes, not part of the answer. If they ask about adjustments in existing firms books, then you have to do all these steps. You need not worry about the adjustments to be done in the new firm's books. So at that time, this will be the part of your answer. If the question is from the point of view of new firm, all these steps will be part of the working notes. So now we'll start with the illustration number 1. Before, I would like to ask any questions or doubts, anything you have? Yes, this is a nice batch. Everybody understands very clearly, no doubts. That's nice. So I will proceed to the illustration number 1.
Sir, 1 minute, sir. We will read and then we will start. Give me 2 minutes.
Sure.
Sir.
Sure.
Thank you, sir.
Okay, good. So I am proceeding to the illustration number 1. The question is that B and S are partners of S and Co, sharing profits and losses in the ratio of 3:1. S and T are partners of T and Co, sharing profits and losses in the ratio of 2:1. On 31st October 2011, they decided to amalgamate and form a new firm, Measures BST and Co, wherein B, S, and T would be partners, sharing profits and losses in the ratio of 3:2:1. So now there are 3 firms involved in this question. The first firm we have to deal with is called S and Co. This is called a existing firm or old firm. And there are 2 partners, B and S, and their profit sharing ratio is given. Another firm is T and Co. This is also an existing firm. This has S and T as partners. Their profit sharing ratio is given. So, Mr. S is a common partner, is in both the firms, S and Co as well as T and Co. Maybe because of this relationship, they want to amalgamate these 2 firms. What is the name they want to have it? The name is BST and Co. This will be called a new firm. And they have chosen what is their profit and loss sharing ratio is. So now they have given their balance sheets. Existing firms will have the balance sheets as below. In the case of liabilities, due to X and Co, S and Co has 40,000. Due to S and Co, T and Co has a balance of 50,000. In the case of other creditors, S and Co 60,000, T and Co 58,000. Reserves, S and Co 25,000, T and Co 50,000. Capitals, in S and Co, P has 1,20,000 and S has 80,000. In the T and Co, S has 1 lakh, T has 50,000 as their respective balance of capital. So on the asset side, I look at the S and Co and T and Co. Cash in hand 10,000 and 5,000. Cash at bank 15,000 and 20,000. Due from T and Co 50,000. This S and Co and T and Co have some mutual credit and debit balances. If you look at T and Co on the liability side, they have 50,000. If you look at the S and Co, they have 50,000 on the asset side. So we have to remember this point. Mutual owings should be removed when we consolidate the new firm's balance sheet. So from that perspective, we have to be alert to this point. Then due from X and Co. Even in the case of X and Co, S and Co also has a 40,000 as a liability and T and Co has 30,000 as a asset. So we can net it off. And other debtors, S and Co 80,000, T and Co 1 lakh. 1,000 vehicles, T and Co only 80,000. Machinery, S and Co 75,000. And building, S and Co 25,000. So this is the balance sheet. So they have some additional information. Let us look into the additional information. What they say, the amalgamated firm took over the business on the following terms. Goodwill of S and Co was worth 60,000 and of T and Co 50,000. Goodwill account was not to be opened in the books of the new firm. The adjustments being recorded through capital accounts of the partner. So here generally goodwill calculation is itself is a big step, but in this sum we are spared. We need not calculate how much is the goodwill. They have ready-made Co 50,000. But one additional confusion is that what is that confusion? They say this should not be showed in the books of new firm. Who is putting these values? These values are put down by the new firm, but they say even though this is the value, we don't want to show it in the books. So what we have to do is we have to in the books of the new firm. So such an adjustment is critical in this particular problem because they don't want to show it in the books of the new firm. So that adjustments we'll see how to do. Then building, machinery and vehicles were taken over at 50,000, 90,000 and 1 lakh taken at a different value. So let's see what is the value of building. Building is only in the books of X and Co. Book value is 25,000, but they are taking over at 50,000. Then machinery is 75,000, but they are taking over at 90,000. And vehicles, it is in the books of T and Co only. Book value 80,000, but the new firm is taking it over at one valuation account. Then provision for doubtful debts has to be carried forward at 4,000 in respect of debtors of S and Co and 5,000 in respect of debtor be carried forward. We should see whether already there any provision for doubtful debts. From the debtors, they have not deducted. Okay. Then we have to look at the liability side. Is there any provision? There is no provision. So there is no existing provision, but they want to provide for provision for doubtful debts. So this has to be adjusted. Compute the adjustments necessary for goodwill. So that is the first part. Second, pass the journal entries in the books of BST and Co. Assuming that excess or deficit capital, taking T's capital as base with reference to share in profits or to be transferred to current accounts. So we have to pass journal entries for goodwill adjustment and journal entries in the books of BST and Co. BST and Co is the new firm. They are asking one. They want to adjust the capital balances in the new firm. They want T's capital as base and adjust the other partner's capital. Any excess or shortfall should be transferred to the current. So once we start working out the problem, it will be clear. The concepts will be clear. So what should be the first step? I have to start with the old firm's books and I have to start with the revaluation account. So let me move on to the, I will put the name revaluation account of S&Co, debit and credit, particulars and amount. So now I have to see, in the case of S&Co, what are the various revaluations that have been agreed? What is revaluation? Whenever book value and the value at which the assets and liabilities are in these two clauses, clause B and C, they talk about revaluation. So I will take the case of S&Co. First, S&Co has some machinery and building. So this building and machinery value. So the case of it is 25,000. Building it is 25,000. How it comes? 50,000 is the agreed value. 25,000 is my cost price. So 25,000, there is an increase in terms of building. Then in the case of machinery, they are taking over at 90,000, but book value is 75,000. So agreed price 90,000, but book value 75,000. So it's a profit. So all these profits I'm showing on the credit side. So it becomes 40,000. But in the second additional information C, they say provision for doubtful debts has to be carried forward at 4,000. This is a provision, increases our profits. Whenever you make provision for doubtful debts, what happens? Our profits come down. So it's a revaluation loss. It contributes to the loss. So I'm making this as 4,000 as the provision for doubtful debts. Now I will see how much is the net profit in terms of revaluation. So 40,000 on the credit side and 4,000 on the debit side. So it is totally 36,000. So what I should do with the revaluation profit? They have to be transferred to the partner's capital accounts in profit sharing ratio. So I should check the profit sharing ratio of partners in S&Co. In S&Co, there are two partners, B and S, and they are sharing profits and losses in the ratio of 3:1. So what I need to do is I have to go to the S&Co and I have to transfer this profit to partners B and S and in the ratio of 3:1. So I have to multiply this 36,000 or 36,400. And in the case of partner S, it is 36,000 total revaluation profit into his profit sharing ratio 1 divided by 4. So he gets 9,000. So now the liability side also 40,000 total, and on the asset side also we have a total of 40,000. So now we are done with the revaluation account in the case of S and Co. Now we should move on to the revised balance sheet. Why I am putting up a revised balance sheet? Because in order to pass the journal entries, if you are preparing a revised balance sheet, it will be very helpful. So what I am going to do is I have to prepare the revised balance sheet of S and Co. So how I will prepare a revised balance sheet? I will take the original balance sheet, and wherever there is a change due to revaluation, I will change it. So S and Co has a cash in hand of 10,000. So I'll write cash in hand 10,000 and balance at bank 15,000. So I'll write balance in bank 15,000. Then due from T and Co 50,000. Due from T and Co 50,000. And debtors, I have other debtors of 80,000, which I'll write debtors 80,000. Stock 60,000. And then furniture 10,000. Now you have to be very careful. This is called revised balance sheet. I am naming it as a revised balance sheet. This is part of our working notes only. It's not mandatory to prepare this, but it helps us in arriving at the journal entries. Journal entries passing will be very simple if you prepare this revised balance sheet. Otherwise also you can pass the journal entries, but you may miss out few points. That's why I do this revised balance sheet. It's always better. It will be a foolproof method. Machinery is 75,000. But what is at which value we are taking over? It is at the value of 90,000. So in the revised balance sheet, I will show machinery at 90,000 and building. The revised balance sheet, I will show the building not at 25,000. I will show it at 50,000. So that is the difference between the balance sheet given in the question and the balance sheet which I have prepared. So I am highlighting the changes where it is changing. Here it is changing. Then on the liability side, due to X and Co 40,000. That will not change. So 40,000 is the liability. Then I'm creditors here. Then provision for doubtful debts. There are, apart from this, only there are reserves and capitals of B and Co, B and S. So what I will do now, I have to make the provision. How much is the provision? Provision is 4,000 I have created. So provision for doubtful debts, it will be 4,000. At this stage, what I should do is that anything related to profit and loss account, general reserves, all those things I have to transfer to the capital accounts of B and S. So if you transfer the general reserves, how it will look like? The total general reserves I carry here is 25,000. So what I should do? I should add it to the capital account of partners. So now let's move on to the capital account of partners. So I'm preparing partners capital account as part of my working notes. So from here I start the original of S and Co. As per the question given, B has a capital of 1,20,000 and S has a capital of 80,000. Then I need to transfer the reserves. How much I should transfer? The total reserves are 25,000. It is shared by B 3/4 and S 25,000 into 1 divided by 4, 6,250. Now another thing is revaluation profit. We have prepared a revaluation account. If you look here, we have prepared revaluation account and B gets a credit of 27,000, S get a credit of 9,000. So I am transferring 27,000 to B and 9,000 to S. So now how much is the capital balance? The capital balance becomes 1,65,250 and 95,250. So this is the balance which I should carry to the revised balance sheet. 165,750, 95,250. So capital here it will be 165,750 and 95,250. So my revised balance sheet is tallied. So what are the adjustments? These three are the adjustments as compared to the balance sheet given in question, and our balance sheet is different this way. And how we got this? It's already given in the question. How we got this one? We have prepared a working note. In the working note, I have prepared a columnar partners capital account. In the case of partners of S and Co, I have taken the opening balance, transferred the reserves, and transferred the revaluation profit, and I have got the up to date. This is done. So this is the revised balance sheet of S and Co. So revaluation account is done. Adjustments for goodwill raising. Should we do it? The new firm is raising the goodwill and still they don't want to show it also. So we need not do any adjustments for goodwill in the old firm's book in this part, and liabilities taken over by the new firm to new firm's account. Assets and liabilities not taken over by the new firm to be transferred to partners capital account in the ratio of their capital. So you have to see whether the new firm is taking over all the assets and liabilities. So here they are not telling anything explicitly about what are the assets not taken over by the new firm. So it is a given that it means they are taking over all the assets and liabilities of the existing firms. So now we have to transfer all the assets and liabilities to the new firm's account. So how to pass a journal entry in the case of a old firm? So we'll pass the journal entry like this. Since all these liabilities have a credit balance, in order to close them, what we need to do? We have to debit them. Similarly, these are the assets account. In our books, they are having a debit balance. In order to close them, we have to credit them. Any difference, it should be debited. Any debited should be in the new firm's account. So first I am starting with the liabilities, X and Co. So in the journal of S and Co, I have this format. I first debit X and Co. Debtor, how much? S and Co debtor 40,000. And then second liability is creditors. Creditors 60,000. And then provision for doubtful debts 4,000. Will it transfer the capital at this stage itself? No. You have to wait because it is not part of the step 3. It is part of the step 5. So for this one, we have to prepare one journal entry, and for this step, we have to prepare a separate journal entry. So here what we will do, we have to debit the new firm BST and Co for the difference of the assets and liabilities taken over. At this point, I don't know what is the difference between the assets taken over and liabilities taken over. How I can check that? I have to do the sum total of all the assets taken over. So sum total of all the assets taken over is 3,65,000. What is the sum total of all the liabilities taken over? 3 items of liabilities taken over is 1,04,000. So what is the difference? The difference is 2,61,000. And that 2,61,000 is essentially our capital accounts. 2,61,000. So now I am debiting the BST and Co by 2,61,000, and I am crediting all the assets taken over. Cash 10,000 and bank balance 15,000, and then T and Co 50,000. To debtors 80,000. Furniture, stock 60,000. Stock is 60,000. Furniture 10,000. Machinery 90,000. Building 50,000. Without preparing this revised balance sheet also, you can pass this journal entry, but you have to be careful with these 2 items and these 2 items. But if you have this revised balance sheet, what you have to do, you can blindly copy all these assets, all these liabilities. You can easily pass the journal entry. That's why I'm passing this journal entry so easily. I have this revised balance sheet with me. So it will be part of the working note. It will be very easy for you to pass the journal entry. So what is the narration? Being assets and liabilities taken over by the BST and Co. If you look at the assets total, 3,65,000 and liability total 3,65,000. Now I'm moving on to the next step 4. It is not there in this particular question. All the assets and liabilities are taken over by the new firm. So I'm moving on to the step number 5. Partners capital account should be transferred to the new firm's account. So partners capital account, it will always have a credit balance. So we have to debit it. So how much? It is 165,750. And in the case of yes, it is 95,250. 95,250. The total will be 2,61,000. It should be credited to the BST and Co. So these are the steps we have to do in the case of existing or old firm. So the steps are prepare a revaluation account, prepare capital account, and prepare a revised balance sheet, so that passing journal entry will be very simple. Then we have to pass this journal entry. Debit all the liabilities, credit all the assets taken over, and the balance should be debited to the new firm which is taking over. And then finally transfer the capital accounts to the new firm. So all the assets, liabilities, capital account, and new firm's account also. It has a debit and credit here. Everything will become 0, our existing books will become closed. So these are the steps as far as old or existing firms books are concerned. But there are two firms, S and Co and T and Co. So we have to do the similar things for T and Co. What are the things? So we have to start with the revaluation account. So once again, let's move on to the question. In the case of revaluation in T and Co, only vehicles are taken over at a different value. How much it is? Book value 80,000, but they are taking over at a value of 1 lakh. So there is a revaluation profit. So the new firm is valuing it at 1. There is a revaluation profit of 20,000. Any more adjustment? Yes. We have to create a provision for doubtful debts, which will reduce our revaluation profit by 5,000. So what will be the total revaluation profit? 20 minus 5. It will be 15,000. Who has to share it? Partners. S and T should share it. What is that profit sharing ratio? For that, we have to look into the profit sharing ratio in the case of T and Co. So T and Co has two partners, S and T, and their profit sharing ratio is 2:1. So I'm transferring the revaluation profit to partner S. He has a profit sharing ratio of how much he has? He has 2 divided by 3. So in the case of partner T, how much he has? He has a capital of, profit sharing ratio of 1 divided by 3. 2:1 means this will be the ratio. A minute. So this is how the partner's capital will look like. Now what next step I should do? I have to prepare the partner's capital accounts. So in the case of partner's capital account, T and Co, two partners, S and T. So what is the opening balance of their capital? Opening balance of capitals. S has 1 lakh, T has 50,000. So S 1 lakh, T 50,000. Are there any reserves to be shared? Yes, reserves are 50,000. How it should be shared? It is in the profit sharing ratio, 2/3 and 1/3. So 50,000 multiplied by 2/3 and 50,000 into 1/3. So reserves are shared by S&P 33,333 and 16,667, and revaluation profit. So we have already worked out the revaluation profits, 10,000 for S, 5,000 for T. So we credit S account by 10,000, T account by 5,000. Now we have to see the updated capital balance. It is 1,43,333 and it is 71,667. This will be useful for the revised balance sheet. So for T and Co also, I am trying to prepare the revised balance sheet. So for T and Co, I have due to S and Co 50,000, due to S and Co 50,000, and creditors 58,000. reserves already transferred to the partners capital account. Provision for doubtful debts. How much we have created? 5,000. So 5,000 here. Now I'm moving on to the, so this is a difference from the balance sheet given in the question and our revised balance sheet. So I'm filling the asset side. Cash in hand 5,000, cash at bank 20,000. Cash in hand 5,000, cash at bank 20,000. Due from X and Co 30,000. Due from X and Co 30,000. And debtors, I have 1 lakh. So I'm filling debtors as 1 lakh. Then stock, I have a stock of 70,000. And I have a furniture of 10,000. Sorry, furniture here is 3,000. And vehicles, here will be a difference. In the question, they have given 80,000, but we have adjusted it to 1 lakh. So here I'll be showing at a value of 1 lakh. So now I have to bring in the capital of 333, 71, 667. So 143, 333 is S capital, 71, 667. 71, 667 is the capital of T. So my revised balance sheet has tallied 3,28,000 assets and liabilities. Now what I should do? I should do the journal entry for transferring all the assets and liabilities to the new firm. So I'm starting with the liability side. S and Co. S and Co has an amount of 50,000. And then creditors 58,000. Provision for doubtful debts 5,000. And debit to BST and Co. How much? It is simply the total of capital accounts. Here it comes 2,15,000. 2,15,000. So on the asset side, cash, bank, X and Co, debtor, stock, furniture, vehicles. So simply to save time, since we are working in Excel, what I can do is I can copy all the assets because all the assets are taken over by the new firm and paste them here. So cash becomes 5,000, bank 20,000, X and Co 30,000, debtors 1 lakh, stock 70,000, furniture 3,000, vehicles 1 lakh. So the total is 3,28,000 and 3,28,000. So this journal entry is over. Now I am moving on to transfer of capital accounts of partners. Here we have seen it is 1,43,333, 71,667. So I am doing here debiting the partners capital account and crediting the BST and Co. That is the new firm by 2,15,000. So now effectively what we have done the closure of the old firm's accounts. S and Co, we have closed it. Now T and Co, we have closed it. If the examination question is only about closure of old books, this is sufficient. But in this particular question, what they have asked, we have to open the books of new firm. So we have completed these steps for both the existing firms. Now we should move on to the opening of the books of the new firm. So what we need to do, simply we have to debit all the assets and credit all the liabilities at the values taken over and credit the partners capital accounts at the values transferred from old firms. So only 2 steps we have to do. So now I will pass the journal entry for this one. But before that, in the question, there are some adjustments. What are those adjustments? Goodwill. goodwill should not be raised. So, but adjustment should be done for the goodwill. So now I will deal with this particular issue. How to do that? You have to prepare a statement showing adjustment for goodwill. Why raising as well as writing off of goodwill? Because they say it should not be opened in the books of new firm. So we have to raise the goodwill. That is the standard thing we need to do. But here, since we are not going to show in the new firm, we have to write it off as well. So what is the value of goodwill in the case of S and Co? It is 60,000. So what we should do? In the case of S and Co, the total value of goodwill is 60,000. In the case of P and Co, the total value of goodwill is 50,000. So this is the totals. So ideally what we should do? So in the case of B, S and Co, there are two partners, B and S. What is their profit sharing ratio? 3:1. So what I will do, 60,000 into 3 divided by 4. So he will get a credit of 45,000. In the case of yes, he will get 60,000 into 1 divided by 4. He will get an amount of 15,000 as a goodwill. Then we will move on to the T and Co. In T and Co, here is it T is not there. In T and Co, yes, B is not there. S is there. His profit sharing ratio is 2/3. So he will get 50,000 into 2/3. And this guy will get 50,000 into 1/3. So total goodwill raised is 1,10,000. So if this goodwill was to be recognized in the books, in the old firm itself, we will recognize this goodwill as 60,000 and we will credit the partners account by 45,000 and 15,000. In the case of T and Co, will show goodwill as an asset at the value of 50,000 and T will get a share of 33,333. T will get a share of 16,667. So overall total will be goodwill of 1,10,000, which will be showed in the books of BST and Co. But what the new firm is saying that they should not show it. So then what it is, the process is called write-off of goodwill. 1,10,000 goodwill is there, but we don't want to show. So we are going to write it off. So how much you will write it off? You have to write it off 1,10,000. So in which ratio we will write it off? In the profit sharing ratio in the new firm. So in the case of B, the debit will be 1,10,000 multiplied by 3 divided by 6. Why 3 divided by 6? The new profit sharing ratio is 3:2:1. So the total number of share is 6. Out of that, B gets 3. So 3/6. So in the case of yes, it is 1,10,000 into 2 divided by 6. And in the case of T, it is 1,10,000 into 1 divided by 6. So this will be the debits. So what is the net effect? The net effect of raising and writing off goodwill is that B gets credit of 45,000, debit of 55,000. So net here gets a debit of 10,000. In the case of yes, credit of 48,333, debit of 36,667. So net effect is he gets a credit of 11,667. And in the case of T, credit of 16,667, debit of 18,333. So he gets a net debit of 1,667. So the journal entry, what we are going to pass in respect of goodwill adjustment is that we will debit B capital account 10,000, T's capital account 1,667, and the credit goes to S, the total amount of 11,667. So this is the net effect of raising the goodwill and writing of the goodwill. Both entries combined, this will be the journal entry which we are going to pass. So this adjustment given in the question is taken care of. So this is done. This is already taken care. This is already taken care. Now we have to move on to answer. Compute the adjustments necessary for goodwill. That is done. Now what we need to do? Pass the journal entries in the books of BST and Co. So now we will pass the journal entries. So how to pass the journal entries? In the concepts we have studied that debit all the assets and credit all the liabilities at the values taken over. Simple. And credit the partners' capital accounts at the values transferred from old firms. So this is what we are going to do now. So BST and Co. I'm moving on to BST and Co. So I'm going to pass the journal entries now. First, in the case of S and Co. How to transfer the assets and liabilities and partners capital account. It's very simple. We already have the cash, bank, T&Co, debtor, stock, furniture, machinery and building. These are the assets we are transferring from S and Co. So what I will do is I can debit all these accounts at these values. So essentially I am copying this revised balance sheet values here, BST account, because these are the assets taken over and these are the values at which they are taken over. So the total value will be 3,65,000. Then on the liability side, what are the liabilities taken over? That is also very simple. These are the liabilities taken over. X and Co, creditors, provision for doubtful debts, capital of B and capital of S. So since I have this revised balance sheet, it is very easy for me to pass the journal entry. So X and Co, creditors, provision, capital of B, capital of S, and the total is 3,65,000. So the journal entry is as simple as that. So now for T and Co, now we will understand what will be the process. So go to the revised balance sheet, take the list of all the assets and debit them. Here I will put it on the debit side. So the total is 3,28,000, which is the balance sheet total. So on the credit side, I'll show all the liabilities taken over. So again, it's a very simple process. I have taken all the liabilities. The total is 3,28,000. So these entries are done. That's it. But in this particular problem, there are two more adjustments. What are those adjustments? Goodwill adjustment. Goodwill adjustment we have already worked out. What is the entry? B account debtor 10,000, T account debtor 1,667 and S account creditor 11,667. So I am debiting the B account. B's capital account I will be debiting by an amount of 10,000. T's capital account I will be debiting by 1,667. I will be crediting the S capital account by the sum total of these two, 11,667. This is the goodwill adjustment, being adjustment for goodwill raised as well as written off. Then we have to do the further adjustments. What are the further adjustments? Assuming that excess or deficit capital with reference to share in profits are to be transferred to the current accounts. So whose capital is the base? T's capital is the base. Based on T's capital, we have to rework the capital of B and transfer to the current account. So for this purpose, what we need to do? For this purpose, we need to work out the updated capital accounts. So let's do the workings for that. So let's move on to the working notes. So what I will do is I will prepare a statement showing capital in new firm BST and Co. So I will have a particulars and partners name B, S and T. What is the revised profit sharing ratio? 3, 2 and 1. What we have to do? We have to bring the balance from S and Co. In S and Co, the revised capital balance of B was 165,750. S was 95,250. Then from balance from T and Co, S had 143,333. T had 71,667. So what is the sum total? The sum total is 165,750, 238,583, 71,667. So what is the sum total? The sum total of capital is 4,76,000. After that, what I need to do? I need to do the goodwill adjustment. Goodwill adjustment, how much? Just now we have worked out in the goodwill. B will have a debit of 10,000. T will have a debit of 1,667. S will have a credit of 11,667. So this adjustment we have to make. So B 10,000. This is minus because it's a debit. And in the case of S, the credit of 11,667. And in the case of T, it's a debit of 1,667. Now we have to take the Mr. T's capital as a base. And based on that, we have to work out the other partner's capital. So in this case, T has a profit sharing ratio of 1. And what is his capital? His capital is 70,000. So we will take this 70,000 as a base and we'll find out the how much is capital is required for the other partners so that they are also in line with T's capital. So in the case of B, how much is required? 70,000 multiplied by 3 because he has a profit sharing ratio of 3. So he has to have, there will be a rounding of error, otherwise it will be 2,10,000. And in the case of yes, 70,000 into profit sharing ratio of 2, it should be 1,40,000. So B should have had a capital balance of 2,10,000. But how much is actually having? Is actually having only 155,750. There is a shortfall or deficiency. Then what we need to do? We have to credit his capital by 54,250 and we should debit his current account by 54,250. In the case of yes, he has excess. He should have had only 1,40,000, but actually having 250. So there is an excess of 1,10,250. So we will debit his capital account and credit the current account by an amount of 1,10,250. So for these capital adjustments, we need to pass journal entries. So in BST account, I will write current account of B. How much I should debit? Current account of B, I should debit an amount of 54,250. 54,250. Where the credit goes to the capital account of Mr. B, 54,250. So now capital will increase sufficiently. Then in the case of yes, what should be done is capital account should be debited, current account should be credited by 1,10,250. 1,10,250. Debit and credit. Here reverse case, capital is debited, current account is credited because he has excess capital. And there is a mutual indebtedness. When you look at the balance sheet at the time first trading itself, we saw that there is a mutual indebtedness. Both S and T now become one firm, but when they were two different firms, T had a liability of 50,000 and S had an asset of 50,000. So now, since both the firms have amalgamated, this mutual indebtedness has to be cancelled. So S and Co will be debited by 50,000 and T and Co will be credited by 50,000. So the mutual indebtedness will be cancelled off. So up to this only the question has asked us, but to improve our knowledge and understanding, what I will try to do is I will work out the revised balance sheet of S and Co. I will take it. Revised balance sheet of T and Co. I will take it. I will prepare the balance sheet of BST and Co. So how to do that? I am copying this revised balance sheet of S and Co. So revised balance sheet of S and Co. I'll copy paste here. This is not asked in the question, but for our clear understanding, I am doing this. So I have the revised balance sheet of S and Co. Now I will have the revised balance sheet of T and Co as well. I will delete this. Now I'm moving on to T and Co. I'm copying the revised balance sheet of T and Co. Okay. So I'm removing the sum. All rows not required. Now I will prepare the balance sheet of BST and Co. So now I will start with the asset side cash. How to work out the cash? Cash balance of S and Co I have taken over, and cash balance of T and Co also I have taken over. 10,000 plus 5,000, it will be 15,000. Then bank account. I have a bank balance of 15,000 here and 20,000 here. So total will be 35,000. And next line is T and Co. T and Co, it will not be there because it's a mutual indebtedness. We have passed a journal entry to cancel out the T and Co here and S and Co here. I'll change the color, maybe a different color. So this is removed. It will not be part of balance sheet of BST and Co. Then next line item, it is here alone. It is there X and Co 30,000. Will it be there? No. This also will not be there because we have asset of 30,000 and a liability of 40,000 here. So net liability will be here. I will show plus 40,000 minus 30,000 here. So net liability of 10,000 here. Then we'll start with the debtors. In the case of S and Co, I have a debtors balance of 80,000, and in T and Co, I have a debtors balance of 1 lakh. It will be 1,80,000. Then in the case of stock, in S and Co, I have 60,000, and T and Co, I have 70,000. It will be 1,30,000. Then furniture. In the case of S and Co, I have 10,000. In the case of T and Co, I have 3,000. So the total will be 13,000. Then machinery. Machinery is in S and Co books only 90,000. Building, it is in S and Co books only 50,000. Then vehicles, it is only in T and Co's books. The value is 1 lakh. Now we have passed some journal entries for current accounts. So current accounts of B will become a asset. So what was the journal entry we have passed? B's current account has a debit balance of 54,250. Because of that, we'll have 54,250 here on the asset side. And on the liability side, X and Co we already have. Now we'll see creditors 60,000 and 58,000. 1,18,000 will be the total. And then we have provision for doubtful debts. Provision for doubtful debts is 4,000 plus 5,000. It is 9,000. Then we have capital account of B, S and T. So in the case of B, capital account will be how much? We have worked out. It should be 2,10,000. It should be 1,40,000 and 70,000. So it will be put it in the same ratio because all those adjustments we have already done. So after the adjustments, it will be 2,10,000, 1,40,000 and 70,000. But for current account of yes, we have a entry for 1,10,250. It will be having a credit balance 1,10,250. So if you have to total the balances, $6,67,250. So on the asset side also, we will be having a balance of 6,67,250. So what will be the differences here? If you simply add up the assets and liabilities, it will not add up because of adjustments in the capital. In the ratio of profit sharing, we have done the adjustments for current accounts. That will be the difference between the revised balance sheet of S and T and Co. Otherwise, you can simply add up the balance sheets of B and Co. Sorry, S and Co. and T and Co. You will get the balance sheet of BST and Co. So in this question, we have seen the comprehensive accounting treatment, both in the case of old books as well as new books, and how to pass the journal entry, and we have even seen how to prepare the balance sheet in the case of a new firm. So I think we would have gained an all-round knowledge about amalgamation of partnership firms and how to do the accounting treatment. If there are any questions, you can ask me, we'll explain in detail. Is there any point that needs any elaboration?
No, that's clear.
Okay, thanks a lot. So if it is clear, we'll proceed with the illustration number 2. It is slightly different. It deals with the sale of partnership firm. So what we have dealt with here is amalgamation of partnership firms. Next, we will take up the case of sale of partnership firms. Before we proceed that, we'll take some 10 minutes break. Exactly after 10 minutes, we'll start with the next problem, sale of partnership firms. See you in 10 minutes. Thank you. So welcome back. We'll start our class again. I'll share the screen now. How to deal with amalgamation of partnership firms. Now I will move on to sale of partnership firm. In amalgamation and sale, what is the fundamental difference is that in amalgamation of partnership firm, there are more than either two or more partnership firms are sold to another partnership firm. In the case of sale of partnership, only one firm is sold. The buyer can be any form of business entity. It may be a sole proprietor, it may be a partnership, it may be a company or whatever. So the difference is basically from the number of firms involved and the type of buyer involved. Otherwise, the existing firms books, the adjustments are the same. What we have to do? We have to do the revaluation account. We have to make adjustments for goodwill. We have to transfer all the assets and liabilities taken over by the buyer. Rather than new, we will call as buyer. And facilities not the buyer be transferred to partners ratio of their capital and capital account should transfer to the new firm's account. This is the exception. Partners account will not be the new firm. The new firm or the buyer will settle the existing partner's capital account. So this is different sale under the firms. From the buyer's perspective, instead of new firm, there will be a buyer. What the buyer will do? He will debit all the assets and credit all the liabilities at the values taken over. And partner's capital account, he will not take it over. So the difference between sale and amalgamation lies in these 2 points. Partner's capital will not be transferred. All other steps are substantially the same. So with this understanding, we'll proceed with the lesson number 2. Let's move on to this illustration. Yes. The question is that on 31st March 2012, Sri Raman acquires on payment of rupees 80,000 the business of Messrs. Gupta and Singh, taking over at book value the following assets and liabilities: debtors 35,000, furniture 3,000, stock 46,000, creditors 10,000. There was no change between 1st January 2012 and 31st March 2012 in the book value of the assets and liabilities not taken over. The same has been continued after the acquisition. Entry of the acquisition cost except for the payment of 80,000 made by Sri Raman. From the following balance sheet and trial balance, prepare business purchase account, profit and loss account for the year ended 31st December 2012 and balance sheet at that date. And balance sheet as on December 31, 2012. On the liability side, capital account, Sri Gupta 30,000, Sri Singh 20,000, total capital 50,000. Bank loan 18,000, creditors 12,000, total is 80,000. On the asset side, furniture 3,000, investments 5,000, insurance policy 2,000, stock 40,000, debtors 30,000, total is 80,000. And furthermore, on 31st December 2012, exactly 1 year after this balance sheet was on 31st December 2011 when it was a partnership firm. But on 31st 2012, what happened? Sri Raman has purchased this business. Sri Raman means what? It's a proprietor only. It's not a limited company. It's not a partnership firm. So a sole proprietor. One single. When he purchased on 31st March 2012. So this is the balance sheet for his. This is December 2011. Now, after the date of his purchase on 31st December 2012, the trial balance is given as stock 40,000, furniture 3,000, investment 5,000, insurance policy 2,000, business purchase account 80,000, bank loan 18,000, capital of Gupta 30,000, Singh 20,000, Raman 30,000, bank 3,000, debtors 48,000, creditors 15,000, purchases 3,20,000, expense 2,000, sales 4 lakh. Balance is not given a balance sheet. This is the trial balance. To the balance sheet. So, what are the things they have asked us to prepare? They have asked us to as well as balance sheet. So, what is the catch in this problem? It is not a straightforward sale and purchase. What happened is they want us to prepare only from the point of view of the buyer. How we know that? Because they want 31st December 2012. So, year end, what is the status of this business? It is a proprietary concern. They are in existence as on 1/1/2012, but as on 31/3, it was sold to a proprietor. So, at the year end, it's only a proprietary concern. So, from the buyer's perspective only, we are going to solve this particular problem. But one confusion what has happened is that usually what happens when one business is sold to another business, it will be differentiated as an existing or old business and new business. The old business books have to be closed and new business books have to be opened. That process they have not done it. So there is a error in accounting. How we know that? Because they say that the same set of books has been continued. But what we should do? We should never continue the same set of books. I was March and should have opened the books of the proprietor from 1st April. But in this question, what they say is it was not done. After the acquisition, no entries of the acquisition have been passed except for payment of 80,000 made by Sri Raman. That's why even at the trial balance at the end of the year, you still see the partner's capital accounts and all. So only a proprietary concern now for the past 9 months, but still they are showing the capitals of partners. So this problem is more of a combination of both sale of partnership firm as well as rectification of error. What is rectification of error? If there were any errors in the accounting entries made, what we have to do? We have to rectify them. So in this case, what is the error? Ideally, they should have closed the books of the partners by 31st March, but that was not done. So it is an error and a new book should have been opened. That was not done. So these errors also we have to rectify. Apart from that, we have to prepare the profit and loss account and the balance sheet. So we have to be very clear that the profit and loss account and balance sheet will be from the perspective of the owner. Who is the owner? Is the sole proprietor. So only from his point of view, his perspective only, we should prepare the profit and loss account and balance sheet. But because of various errors, we have to make some adjustments in the nature of rectification of errors. So it's a combined problem of rectification of errors as well as purchase of partnership. Not even sale. We are looking from the point of view of the purchaser. So how to solve this problem? We'll start with the solution. So let's move on to the illustration. So what are the conceptual issues involved here? First of all, if we prepare the profit and loss account for the entire year, first 3 months profit that will belong to the partners. Next 9 months profit will belong to the proprietor. And there is an purchase, and only some of the assets and liabilities are taken over, and they are taken over at an agreed value. So what we have to do is we have to ascertain the value of assets and liabilities taken over, and we have to find out whether there is any to find out. So that values are also not available as on 31st March. Straightforward, they have not given. They have given a balance sheet of 31st December 2011. So it's more confusing. Again, we have to see what is the status as on 31st March 2012. Then only we'll be able to find out exact amount of goodwill or capital reserve. So let's move on to the solution. So what are the accounts required? We have to prepare business purchase account, profit and loss account, and the balance sheet. So we'll open one by one. So below that itself, I will prepare for illustration number 2. I will prepare the profit and loss account for the year ended 31st December 2012. Then balance sheet of Sri Raman as on 31/12/2012 and prepare. And we'll have to work out the goodwill, amount of goodwill. That's the first step we have to do. So first, value of assets taken over by Sri Raman on the date of acquisition that we need. So based on that only we can work out the goodwill. So here it is given. These are the assets taken over at book value. Debtors 35,000, furniture 3,000, stock 46,000, creditors 10,000. So 3 assets, debtors, furniture, stock taken over, and 1 liability, creditors also taken over. So based on this we have to find out the value of goodwill. Because purchase consideration is 80,000, we need to find out whether we have paid any goodwill or is there a capital reserve. So debtors, what is the value of debtors? The debtors have been taken over at a value of 35,000. And stock, they have been taken over at a value of 46,000. And furniture, it has been taken over at a value of 3,000. So 3 assets taken over. What is the total of 3 assets? The total of 3 assets, 35, 46 and 3 is 84,000. From that we have to deduct the value of liabilities taken over. How much is the value of liabilities taken over? 10,000. So we have to deduct the value of liabilities, 10,000. So what is the net value of assets taken over? 84,000 plus minus 10,000. It is 74,000 is the net value of assets or liabilities taken over. But how much we have paid? We have paid an amount of 80,000. Net assets taken over 74, amount paid 80,000. So we have paid a goodwill of how much? We have paid a goodwill of 80,000 minus 74,000, 6,000. So these assets are worth 84. This liability 10 minus 74 plus 6 goodwill 80,000. That's why we have paid an amount of 80,000. So we have to recognize an asset called goodwill and the amount will be 6,000. And next, the next step is we have to find out the profits for the year and we have to separate it between how much earned between 1st January to the partnership firm. So those profits belong to the partners only. So we have to find out the profits that have been earned between the period 1st January to 31st March. How we can do that? If there is a trial balance, we can easily prepare a profit and loss account. We'll credit the sales, closing stock, debit the opening stock purchases, and we can find out the gross profit and net profit and so on. But in this case, the trial balance they have given is for the period of 31st December 2012. For entire 12-month period, they have given the trial balance. So sales 4 lakhs is for the entire year. Purchases 3,20,000 for the entire year. Expenses 12,000 for the entire year. So how to differentiate between what happened in the first 3 months and what happened in the next 9 months? It is not possible from this trial balance. Then we have to look for clues elsewhere in the question. So what is that we have? We have the balance sheet as at 31st December 2011. And one more clue they have given is that there was no change in 1st January 2012 and 31st March 2012 in the book value of assets and liabilities not taken over. They are saying that, so from this information, we will be able to construct the balance sheet as on 31st March 2012. What they say, in the value of assets and liabilities not taken over, there is no change between these numbers and 31st March numbers. So what are the things that have changed? These 3 assets have changed. This liability has changed. All other assets and liabilities have not changed. So what we can do is we can compare the net assets as on 31st March 2012 and 31st December 2011 and we can find out the profits because any change there will be reflected in the profit only. So now we will compute the profit during the period 1/1/2012 to 31/3/2012. So we'll prepare a statement like this: particulars, net assets on 1/1/2012 and net assets on 31/3/2012, and the difference will be the profit. So we have to see what is the amount of furniture. 1/1/2012, the furniture value was 3,000. The stock value was 40,000. Debtors value 30,000. And creditors 12,000. We are not going to take any other assets and liabilities. Why? Because they say that they have not changed between 1/1 and 31/3. None of the assets and liabilities except these 4 changed. So we will take only these 2. And we will take the value as on 31/3/2012. What are the values? It's given here. Debtors 35,000. So debtors 35,000. They have increased. Furniture 3,000. They have not changed at all, basically. 3,000. And stock 46,000. It has increased by 6,000. and creditors decreased by 2,000. So 10,000. So now what is the gross assets? The value of gross assets is 84,000, 73,000 as on 1/1/2012 and 84,000 as on 31/3/2012. What is the value of net assets? That is gross assets minus creditors, 61,000. Here it is 74,000. So the assets of the firm has increased by an amount of 13,000. It means that is the profits the firm has made during the period 1/1/2012 to 31/3/2012. We cannot do it in a direct method. We will have to do it in a indirect method by comparing the net assets. So we have found out that the profits are 13,000 in the first 3 months. So these two are the working notes necessary for us. Now we can move on to prepare the profit and loss account and balance sheet. So before we proceed to the balance sheet, what we need to do? We have to work out the profit and loss. So entire year sales, we can take it from the trial balance. So entire year, the sales were 4 lakhs. So we'll take sales as 4 lakhs and closing stock. How much is the closing stock? Closing stock is given as 50,000. So I give the 50,000 as the closing stock. I have to look for opening stock. Where it will be? They have given the balance sheet as on 31st December 2011. So this is the opening stock. I have an opening stock of 40,000. And then I have purchases. How much purchases have I made? 3,20,000. And there are expenses to the extent of 12,000. Expenses 12,000. So now I will see on the credit side, I have got a total of 4,50,000. On the debit side, I have only 3,50,000 minus 3,72,000. 78,000 is the profit. Profit for the year 78,000. Now, what is the profit the proprietor has made from 1st April to 31st December? Then we need to deduct the first 3 months profit. First 3 months profit, we have already worked out, it is 13,000. So what is the profit that belongs to the proprietor? 78 minus 13, it is 65,000. So net profit for the period is only 65,000 from the point of view of the proprietor. Then what to do with this? Another 13,000. It's a capital profit, or it should go to the business purchase account, because this is the profit prior to the acquisition. So we will transfer this 13,000 to the business purchase account. So our profit and loss account is done. Now we'll move on to, this is the critical thing in this particular problem, because in the nature of rectification of errors, we had to do this. Otherwise, it will be a simple profit and loss account. Now I have to prepare the balance sheet. In this balance sheet, I will show only the assets and liabilities which I have taken over. So what are the assets and liabilities I have taken over? I have taken over 3 assets: debtors, furniture, stock. So from the closing balance sheet also, I will take debtors, stock and closing balance. So stock is 50,000. Closing stock is given as 50,000. So I'll show my stock as 50,000. And value of furniture, my closing value of furniture is 3,000. So I will show this 3000. And debtors I have taken over. How much is the value of closing debtors? Closing debtors, the value is 48,000. Stock furniture. Investment is not taken over. If you see, the investment was there in the opening balance sheet, and there was an insurance policy taken over this investments and insurance policy. So we will not take this to our balance sheet. Business purchase account also adjustments has to be done. We will not take this. Bank loan, it was also in the opening balance sheet. We have not taken over, so we should not show it in the balance sheet. And capital of Gupta and Singh, this is partners capital. The partnership firm should have already closed, so we should not take this also to the balance sheet. Then Raman's capital account, 30,000 is there. That also we have to see after the business purchase account adjustment only we'll have to see how much is there. Then bank, we have to see whether bank account was there in the opening balance sheet. In the opening balance sheet, no item called bank, so it is a new asset created after the proprietorship. So 3000 is the bank. Then there is goodwill. We have worked out the goodwill is 6,000. So we have worked out that there is a goodwill of 6,000. So that we need to show here. Goodwill 6,000 is one of the assets we'll have to show. Debtors already we have shown. Purchases is part of the P&L account, and expenses also part of the P&L account. So on the trial balance, credit balance, credit items, bank loan we have not taken over. Gupta's capital will not take over. Singh's capital will not take over. Creditors have a balance of 15,000, which we should take it to the balance sheet. And Raman's capital account is 30,000. Since it is Raman's capital account, we will take it as 30,000. Now we have to work out the business purchase account. So business purchase account, how much balance is there? The business purchase account has a balance of 80,000. So 80,000 is the business purchase account debit balance. So how it should have been adjusted? All those assets and liabilities not taken over should be adjusted with the business purchase account. So two of the assets were not taken over. What is the two of the assets? Investment and insurance policy. What is the value of investment? Investment is 5,000. Insurance policy is 2,000. These two assets were not taken over. So it should be adjusted with the business purchase account. And on the credit side, bank loan is not taken over. The value is 18,000. So bank loan not taken over, 18,000. Capital of Gupta and Singh, 30,000 and 20,000. These are also not taken over. And we have paid a goodwill of 6,000. And first 3 months there is a profit of 13,000. So if you look at the business purchase account, the credit side will be 87,000 and debit side it will be 87,000. So what is the remaining balance? Business purchase closed. So what is remaining? We have to take the net profit for the year to Raman's capital account. What is the 65,000, which we should take to the capital of Sri Raman, 65,000. So now if you look at the assets, the total is 1,10,000 and the liabilities it is 1,10,000. So the problem is solved now. If there was no issues, ideally what should have happened? The business purchase account would have been prepared in 31st March 2012. At the time itself, we would have transferred the assets and liabilities not taken over by the proprietor to the business purchase account. And goodwill also would have been computed at that time itself, and profit and loss account also would have been prepared that time itself, and this business purchase account would have been closed by that time itself. So only the remaining assets, what are the remaining assets? Stock, furniture, debtors and goodwill will be there. Bank account is a new account which is started after the proprietor has purchased the business. That will be there. And one of the liabilities taken over will be there. And whatever capital introduced by Mr. Raman after 1/4, that will be part of this Raman's capital account. And net profit for the next 9 months will be added here. And profit and loss account, ideally, we would have omitted that part of sales, expenses, purchases, which are 1st January to 31st March. And rest of that only should be part of our trial balance. So we would have straight away got a profit of 65,000. Since they included the prior 3 months portion also, that's why we had to ascertain the net assets between 1/1 and 31/3 and find out this 13,000, which is a pre-acquisition profit. So these additional steps were required. This is an additional step, and this is an additional step now. And in the working notes also, sorry, in the goodwill also, this was an additional. Goodwill was anyway required. Calculation of profits were additional step. So these things were additional. Otherwise, it will be a very simple and straightforward question only. Due to this error, we had to do these additional steps. It may be a bit confusing initially if you look at the problem. If you go through the problem once or twice, then you will get a very clear idea why it is a normal, not a normal sum. It's a little bit different. So any questions or doubts? Okay, thanks a lot for joining the class. Do join me tomorrow also. So tomorrow also we have a class at 6:30 in the morning. Please join the class. Thank you.
Thank you, sir.
Thank you.